What's going on, guys? Welcome back to the show. In this video here, I'm going to be doing an analysis on Alibaba. This company's been making so many headlines over the last several months. There's VIE structures to being delisted to dropping to all-time lows from all-time highs. In this video, I'm going to look at the fundamentals, the financials, and finally determine a price to pay for this business. If you're new to the channel, welcome. My name is Leo, and my channel is dedicated towards all things investing. So I'll stop blabbering. Make sure you hit the subscribe button, and anything mentioned in this video will be in a link in the description below. Let's jump in to Alibaba. So this company's very interesting, based out of China. It's been very controversial. And it's been controversial in the sense because, you know, there's a lot of political tensions with China and Taiwan and their relationship with the US. The massive price decrease over the last year or so. Well, we had this, you know, run up in October 2020 of 308, and slowly we've been making our way down to now $100 a share. I personally, full disclosure, have a small position in Alibaba because I personally believe the fundamentals of this business are great, and where it's going to be in the next 10 years is going to be much larger than it is today. But enough about that. Let's jump into it. We're going to look at the company metrics first. And what we're going to do here is we're going to look at the 5-year averages compared to our trailing 12 months and kind of gauge where this company currently stands. So PE ratio is slightly decreased from our 5-year average. EPS is positive, but slightly lower than our 5-year average. Return on equity is a little bit lower than our 5-year average. Profit margin, slightly lower. They were getting a little bit hit over the last little while. Now, granted, the way they report things is different than any other, not any other, but I believe because they're a Chinese company, they don't have to report on a quarterly basis. So they do report on an annual basis. So these numbers may come across a little bit skewed. Revenue, $836 billion. That's obviously in Chinese dollars. I don't know if that's what their currency is. I feel like I should know that. Net income, $65 billion. Free cash flow, slightly increased over a 5-year average, with the return on invested capital being at 5% compared to our 5-year average of 9%. Almond Z-score is 1.63 and Piotrowski score is 6. To be completely frank, folks, when it comes to at least a foreign business like this, I kind of ignore this company metrics category, and not just to like say a bias towards Alibaba, but because it's reported in a way that's different than, let's say, US listed companies or Canadian listed companies or whatever, it kind of gets these numbers skewed. Like, there's no way that Alibaba is at a 1.63 Almond Z-score. And I'll tell you why. There's a lot of assets on hand, and they have very little debt. So, not very little debt, but their debt is manageable, that they're not going to be put in a position where they might go bankrupt. Anyways, my thoughts are simply that on the company metrics side. Let's jump into the financial evaluations to determine what the score means. We're scoring it at 7, folks. I'll just jump into the detailed list right here. So, where it's not earning points from me is in the 5-year PE average, sitting at 35, right? And with that being 35, you know what? Here's the thing. You have this massively growing company in a massively growing economy, which is China. The middle class has been getting wealthier over the last several years, and they're predicted to be they are an economic superpower, right? And probably going to take over the US within the next 10 years. So paying this much for a business would make sense, granted this expansion and growth continues, right? Because fast-growing businesses can somewhat justify a high PE. Share dilution, we're not going to get any points over there because, well, they're diluting us, and we want companies to either be decreasing the amount of shares outstanding or staying the same. So this is a slight increase over the last 5 years of 2.8%. It's not the worst thing, but it's an increase nonetheless. We are also just slightly underneath that 10% return on invested capital average. It's at 9.38. It's still a decent number to begin with, but it's not that 10, so we're gonna mark that as a 0 there. All right, so that's it for the negatives. Let's look at the positives of this business. We have a current ratio of 1.64. So that indicates to me that they have enough assets on hand to cover their liabilities, as well as, well, still some more fuel left in the tank in case they had to liquidate a lot of stuff. We want this over 1.5. We have that. Return on equity, we have it at 17%. We want that to be over 15%, full 15% or more. We have that. Now, here's a huge one, folks. We have EPS growth. Massive growth. Massive growth. I don't know if you're seeing that, but I'm sorry. Well, it'll make sense if I pull myself away from that. But look. 5,400% increase of earnings per share. So you as a shareholder, your earnings are just been skyrocketing over the last 5 years. $158 billion. Obviously, this is in, oh God, what is it? What is China's currency? It's going to bother me. Is it yen? Is it yen? Please say yes. And now we're at almost 800 billion. 700 billion for 2021. So debt to equity is super low as well. We're sitting at 17.49%. We want that to be underneath 50, folks, and we have that. Net income growth, massive growth in net income, massive growth in free cash flow growth, and massive growth in revenue. The trifecta. This is what we want to see, folks. We want to see this company growing over the last 5 years immensely, and it's been doing that. And now, look, you take that back to, like, I was looking at 2016 numbers. The current price is about $100 right now. You're telling me that around 2016, September 29th, 2016, it closed at 105, right? In March 2022, we're sitting at $100 a share, and the free cash flow has grown God knows how many times over. So far, it's showing a 200% increase on free cash flow growth. And you're telling me this company is now worth $100 a share? Really? I don't think so. I don't think so. I think it's worth a lot more. Actually, I'm going to say I know it's worth a lot more. Because there's no way you have the likes of Charlie Munger and a lot of other top value investors jumping in on this stock without the numbers making sense like the way it is. And especially someone like Charlie Munger who's tripled down on his position. So those are my thoughts on this financial valuations category. There's this huge trifecta of just revenue growth, and everything in this company has just been going up. However, there is the political side of Alibaba that must be talked about as well, right? Because this is what, I guess, accelerated this decrease or sell-off in the amount of shares was this whole VIE structuring. And this, look, VIE structure has always been part of this whole Alibaba, JD.com, all these Chinese companies. They've all have this structure put in place for you, a shareholder that's based in North America, to own this business. And here's the worst case scenario. Hypothetically, let's say this business does get delisted. What will happen is that your shares will now just go to the Hong Kong equivalent. Talk to your individual brokerages and see what happens there. I mean, I definitely have to talk to mine, full disclosure, but it seems like the going thing is this. If this company delists from that exchange, it's just going to go to the Hong Kong exchange, and then afterwards you'll have shares on the Hong Kong exchange, and then if you had to sell, well, then you have to go through whatever that process is, and then that money would take however long it would take to get into your account. So essentially it becomes a pink sheet stock, if I'm correct. That thought has scared people beyond an immeasurable fear. They had this lemming mentality to just sell off this business because, one, it's a Chinese business, and two, it's not going to be traded on the New York Stock Exchange. Listen, these are moments, folks, where if you see the irrationality in people, this is where you have to be a lion in the tall grass and pounce on the opportunity. This is one of them. Anyways, enough of me blabbering. Let's jump into a price analysis to determine what a fair price to pay for Alibaba would be. And if you're liking the video up until this point, make sure you hit the like button and the subscribe button. If you know me by now, doing those two things makes me feel warm and fuzzy inside. And also, if you're enjoying this software you see in front of me, which you'll probably enjoy this little bit here, you can get this. This is available. I'm working to make this into an app. Send me an email on my channel. My email will be down below in the description. That's invicticamedia@gmail.com. Anyways, here's the price analysis section. Now, I can do 3 different estimates of Alibaba. We're going to go for a 10-year analysis. The numbers we have to play with are 40% revenue growth, 48, and 49. I'm not going to do that at all. I am going to be super conservative, and I'm going to go with 8, 9, and 10. super, super low numbers. Profit margin, I believe they can keep those margins at where they are. So let's go with 20, 21, and 22. Free cash flow margin, we'll do 25, 26, 27. And price to free cash flow, we'll go 10, 12, 14, with a PE ratio of also 12, 14, and 16. We're sitting at 26.90 for our trailing 12 months. So now, granted, as we hit, let's say, a 10-year number, we should be paying a lower multiple, right? Because the company's gotten larger. Unless you're Tesla, then you pay God knows how much. So, desired return, we're going to put it at 13%. And this is why, guys, this is why I'm a buyer of Alibaba. Technically, I bought it back in April at 242, and by these metrics, I was still in that value range, still had a slight margin of safety. But at these prices here, folks, it just makes absolute sense. Now, I've bought personally enough where I've maxed out my position, and it is slightly higher than the current price right now. I believe I'm like in the 160 to 170 range. So I would love to buy it at this price, but I don't want to overly expose myself to this company. However, if I hadn't bought it at that price before it hit this massive decrease, right? Because this is when did that happen? Yeah, 177 in October 2021, and then it's just been just falling down the hill. But this is what I mean, folks. We're green across the board, with very limited revenue numbers. 8, 9, and 10%. I mean, I'm curious. If I do 4, 5, and 6, look, 168. 168, pretty much what would be my average cost, assuming a 13% return rate. I mean, look, if I even make this return rate even higher, let's say I want to go, if I go 15, can I get, let's say if I go 15% return, it's green. It's going to be green. Can go, I don't know, if I do 25% return. Look at that. I mean, a little bit more, we're showing some red on the DCFs, but it's not too far off. 85, 72. It was hovering around these numbers not too long ago. Look, 73. It got as low as 73. To me, Alibaba is a no-brainer. But listen, you have to do your own due diligence. This is all just entertainment. It's not actual financial advice. You have to take the steps and look into these companies. And this is something that you might have to stomach. It's one of these companies that you have to develop a strong gut for, because look, it's going to be volatile, but it might be on this resurgence of jumping back up to where it should be properly valued at. I've posted a lot of stock analysis videos, but there's one video in particular that I thoroughly recommend you check out, and it definitely relates to what's going on here, and that's like how to actually improve and be a better investor. You can find the link right up. No, I got it wrong again. Right up there. It should be popping up right now. So check out this video. That's the one you want to look at, because that'll give you some tips on how to actually stomach these things, right? And this is why. This is the reason. Look, minimal growth needs to happen to justify the numbers of this company. It's just a solid business. But those are my thoughts, guys, on Alibaba. Do your own due diligence, understand the risks that come with it, and that is being a foreign company that's based out of a communist country. But look, if the stock market shut down tomorrow, would I be happy owning Alibaba? Yeah. Numbers make sense. And I don't think the Chinese government is going to want this company to crumble. That's it. That's the video. Thank you so much for watching, and thank you for putting up with my blabbering. I'll see you in the next one.